Ever feel like you're working harder but your money just doesn't go as far? You get a pay raise, but somehow you're not getting any richer. It's a frustrating feeling and you're not alone. The culprit: inflation. But what if I told you that inflation isn't just some random economic weather storm? What if it's actually a system, and in some ways, it's designed to make the average person poorer? Let's break down this controversial idea and see how it really works. First, let's get the official story. Most economists and central banks will tell you that a little bit of inflation, say around 1%, is a good thing. They say it encourages people to spend and invest their money, rather than hoarding it under the mattress. If your money is slowly losing value, you're more likely to put it to work, which stimulates economic growth. It also makes it easier for wages and prices to adjust. This all sounds reasonable on the surface, but there's a much deeper and darker side to this story. Think about who creates money. It's not you or me. It's central banks, like the Federal Reserve in the US, when the government needs to spend more money than it collects in taxes. For things like infrastructure projects, social programs, or bailouts, it has a few options. It can raise taxes, but that's politically unpopular. It can borrow money by selling bonds, or it can have the central bank create new money out of thin air to buy those government bonds. This last option is often the easiest path. When new money is pumped into the economy, the total amount of money increases, but the amount of goods and services available for purchase doesn't magically increase at the same rate. You have more money chasing the same amount of stuff. What happens? Prices go up. That's inflation. It's a hidden tax. Unlike income tax, which is clearly stated on your paycheck, inflation silently eats away at the value of every single dollar you own. Your savings are now worth less. Your salary can buy less. So who benefits from this? The first recipients of the newly created money. When the central bank creates money, it doesn't just get distributed evenly to everyone. It goes first to the government and large financial institutions. They get to spend this new money at its current value, before it has circulated through the economy and caused prices to rise. By the time that money trickles down to the average person, like you and me, prices for groceries, gas, and rent have already gone up. We're left playing catch up. The rich, who own assets like stocks, real estate, and commodities, often see the value of their holdings increase with inflation, making them even richer. The wealth gap widens. This process also benefits debtors and punishes savers. And who is the biggest debtor of all? The government. Inflation allows the government to pay back its massive debts with money that is worth less than the money it originally borrowed. If you're a responsible person who saves money in a bank account, you're on the losing end. The small amount of interest you earn is almost always wiped out by the real rate of inflation. In essence, your savings are being devalued to help fund government spending and benefit those closest to the money printer. So, while we're told that a little inflation is necessary for a healthy economy, it's crucial to understand who it truly serves. It is a system that systematically transfers wealth from the average citizen and saver to the government and the financial elite. It discourages saving and pushes people into taking on more risk in the stock market just to keep pace. It has a silent force that can lock people into a cycle of working harder just to stay in the same place. Understanding this is the first step toward protecting your own financial future. Thanks for watching. If this video opened your eyes, hit that like button and subscribe for more content that challenges the way you think about money. See you next time.